When a major corporate acquisition is finalized, the financial press announces a single, massive number. You see headlines stating a business was acquired for $500 million, and that figure anchors the public narrative. That $500 million is the enterprise value. For outside observers, there is a persistent assumption that this top-line number equals the actual cash windfall delivered directly to the seller's bank account. In reality, the actual cash proceeds distributed to the seller's shareholders are often drastically lower. A $500 million enterprise value can easily dissolve into $387 million in final payout by the time the ink dries. A sell-side M&A advisor is hired to prevent that erosion. Their mandate requires generating competitive tension to maximize the headline price, but they also have to maximize the certainty of the deal closing and negotiate highly specific non-price legal protections. Building a pristine valuation model is only step one. The true rigor of M&A lies in defending that initial valuation against the strict contractual mechanics designed to chip away at it before closing. We are going to deconstruct the exact mathematical bridge between a publicized enterprise value and the final cash payout to shareholders. That bridge is built inside the Sale and Purchase Agreement, or SPA. This document serves as the definitive legal battlefield where final value is negotiated and locked in. We will analyze the three primary structural mechanics of this agreement: the cash-free, debt-free convention, the working capital peg, and post-closing indemnification. Each of these mechanics shows exactly how an M&A advisor turns qualitative leverage, like multiple competing buyers, into quantitative legal protections for their client. Mastering the math inside the SPA is the only way a finance professional ensures they don't lose millions of their clients' dollars to contractual adjustments at closing. The vast majority of M&A transactions are negotiated on a cash-free, debt-free basis. This is the universal baseline rule for calculating a purchase price. Enterprise value prices the core operating business independently of balance sheet cash or debt. We add the $30 million of existing cash on top, increasing the seller's payout. Conversely, removing the $80 million debt liability reduces the net payout. The calculation is straightforward. Enterprise value plus cash minus debt equals the preliminary equity purchase price. This equity purchase price, not the headline enterprise value, is the true starting line for further cash distributions. Next is the most heavily debated pre-closing adjustment in the contract, the net working capital peg. This peg solves a specific risk. Without it, a seller could artificially strip cash out of the business in their final days of ownership by aggressively collecting receivables and delaying payments to vendors. To prevent that, the buyer and seller agree on a required level of operating liquidity. This is typically calculated as a historical trailing average of the working capital the business actually needs to function smoothly. In this scenario, the working capital peg is a target of $50 million, but actual delivered working capital is only $45 million. Because of this $5 million shortfall, the purchase price is reduced dollar for dollar, bringing our total to $445 million. The working capital peg forces sellers to deliver a fully functional, sustainably capitalized business, protecting the buyer's day-one operational stability. Even after the deal officially closes and the paperwork is signed, the seller's money is still vulnerable to post-closing risks. During negotiations, the seller makes factual promises about the business, called representations and warranties. To ensure these promises are true, buyers hold back 5 to 15% of the purchase price in a locked escrow account. Here is how that looks in practice. Out of a $300 million purchase price, a 10% slice, $30 million, is detached and placed into escrow. Months later, the buyer submits a $12 million indemnification claim for a breached representation. Sellers negotiate a $2 million threshold, or basket, to block minor claims. The financial impact differs completely based on whether this threshold is a deductible or a tipping basket. On the left, a deductible only pays out the excess amount over the $2 million threshold, limiting recovery. On the right, a tipping basket pays the full claim amount from $1. The buyer recovers everything. A sell-side advisor must rigorously fight for a deductible structure to insulate the seller's escrowed cash from being rapidly drained by the buyer. Sometimes buyers and sellers hit a stalemate on valuation. The seller demands a growth premium, but a financial sponsor refuses to pay upfront for unproven projections. The structural compromise is an earnout. This is contingent deferred consideration paid only if the business hits specific targets after the deal closes. A standard earnout requires a baseline performance threshold to be met first. A financial multiplier is applied only to the excess performance. The target is year 2 EBITDA exceeding $20 million. The business achieves $32 million, creating a $12 million excess. We apply a 2.0x multiplier to that excess, calculating a $24 million earnout payment, added to the original upfront consideration. Buyers will also insist on a strict payout cap, perhaps a $50 million maximum limit, to ensure their financial exposure remains controlled. Earnouts allow sellers to monetize their optimistic projections while providing downside protection for buyers who refuse to overpay for hypothetical success. Now we bring all these mathematical components together into the final legal structure, the net proceeds waterfall. Here is the waterfall chart mapping our final payout. We start at the top with the $445 million adjusted equity purchase price we calculated after accounting for cash, debt, and the working capital shortfall. The first deduction off the top goes to the advisors and lawyers. We subtract $8 million in total deal fees. Preferred equity holders are paid next via their liquidation preference, stripping away another $50 million before the common stock gets anything. We calculate the final payout by dividing the remaining $387 million by 100 million fully diluted common shares. That yields exactly $3.87 per share. The strict priority of the waterfall means standard common shareholders absorb the economic damage of every single price adjustment, true-up, and penalty negotiated in the contract. This vulnerability to contract adjustments is why buyers attempt a tactic called retrading. This is the opportunistic practice of using late-stage diligence findings to push the agreed-upon purchase price down right before closing. A tightly managed 4-phase competitive auction is the sell-side advisor's only reliable defense against this late-stage maneuvering. Maintaining multiple live, credible bidders deep into the final phases of diligence prevents any single buyer from holding the seller hostage over specific contract terms. Securing a massive valuation on an initial marketing teaser means absolutely nothing if the advisor loses those gains in the fine print of the final agreement. Price is the fiction you negotiate on a whiteboard. The contract terms dictate the reality of what you actually take home.